Hello and welcome back to the remainder of the chapter 13 lecture where we're talking about current liabilities. And I stopped short last time of discussing, I had a long list of current liabilities that I wanted to discuss with you. And I stopped short primarily because my last current liability that I need to cover in that list is closely connected to a topic that I needed to expand upon. And that is what happens when we have current liabilities. We have, I should say, long-term debt, and it's coming due or it will be paid within the next year. Well, we know if we're going to use current assets to extinguish it, then it should be shown as a current liability. But there's some long-term debt where we're not using current assets to extinguish them. We've set aside money through the use of a sinking fund to retire them, or they may be refinanced, or it may be convertible debt where it's going to be converted into capital stock, or common stock. In those situations, those amounts are not shown as current liabilities. So again, if you remember the primary focus of, as long as I use current assets to extinguish the debt is classified as a current liability. This is why when bonds come due, we don't reclassify them as current maturities of long-term debt, because most of the time to retire a bond, we're using a sinking fund that was set aside for that purpose. And that sinking fund is a long-term asset. So any debts that are coming due should not be classified as current debt. If they fall into one of these three categories, if they're retired by using non-current assets, if they are refinanced, or if they are converted into stock. Which brings me to refinancing, because the refinancing piece requires a separate sort of longer discussion. We know that current liabilities have to be extinguished by current assets in order for them to be reported as current liabilities. But what if the debt is refinanced? Is there a situation when the debt is refinanced and it ends up showing as long-term, or actually ends up showing as current? And that's typically based on this criteria here. So if we have debt that we expect to be refinanced, now if I know for sure it was refinanced, then I know what to do with it. But what about if I'm expecting to refinance it? Both of these conditions have to be met. The liability is going to be settled within more than 1 year, and if that's the case, then it's shown as a long-term liability. Or if the corporation has the contractual right to push off the settlement, or they can say, hey, we're not going to pay this for at least 1 year, or the company's operating cycle is longer after the balance sheet date. Again, the focus is this time on debt that we are expecting to be refinanced. So this one makes a little more sense when we look at an example. So November 30th, 2020, we have this winery and they issued a note payable of $3 million. The note is due in the following year, the next year, February 28th, February 28th, 2021. Just looking at that information there with the balance sheet date being December 31st. If we look at that, those two sentences, and we assume that's the only information we have, then we can assume that they're going to pay it off using current assets. It would be a current liability. But let's continue reading. Let's see what happens. So we see that the company, their balance sheet date is December 31st, and they issue their financial statements on March 1st. As of March 1st, they plan to extend the maturity date of the loan to June 15th. How do we deal with this debt? Is it classified as current? Is it classified as non-current? Because if we just look at maturity date, it's current. But because there's an expectation that this will be refinanced, then we have to look at the loan agreement in detail. So let's take a look at the questions. What's the accounting treatment for the short-term debt to be refinanced if it is actually refinanced on January 15th, 2021? Now, if we refinance this, then we're not going to have to pay this thing until June, what did it say? June 15th, 2022. So that's a whole year out. So in that situation, because the refinancing is not expected to be completed by December 31st, it is shown as a current liability. Yes, I know the details of the contract say, hey, we can do it, but the refinance does not happen by the balance sheet date. So in that situation, it is a current liability. I got to know by the balance sheet date. Now, let's look at the second situation. What's the accounting treatment for the short-term debt if a contract to refinance is actually completed by December 31st, 2020? And remember, in that contract, we can push out that payment date until 2022. Well, if the refinancing agreement has been entered into and it's completed by December 31st, then we can show that amount as a long-term debt. You might be thinking, well, why is this important anyway? Remember that we analyze the liquidity of a company, whether or not they're able to meet their short-term obligations by looking at their current assets divided by their current liabilities. If a company is liquid, then they have enough current assets on hand to be able to meet their current obligations. So it makes them look like a stronger company. So if we can reduce our current liabilities by refinancing something and making it into a long-term liability, yes, that changes my solvency position. In other words, my ability to meet my long-term obligations, but it also, in a negative way, but it also changes my liquidity position in a positive way if I'm able to refinance. So GAAP has these rules that say that refinancing arrangement has to be completed before the balance sheet date in order for you to show that current liability as non-current. If the refinancing agreement happens after the balance sheet date, then you got to show that amount as a current liability. You can disclose it, but it's still a current liability. So now let's look at some gain and loss contingencies. These are some fancy terms here, but when I show you these in detail, quite a few of these you should be familiar with, because we looked at some loss contingencies in Accounting 1. So a contingency is basically we're waiting for something else to happen, and that's going to determine whether or not we're going to receive money in the future or whether or not we're going to owe money in the future. So let's deal with gain contingencies first. With a gain contingency, I may be in dispute with the IRS and I'm expecting to win. So I expect the IRS to give me a refund. That's an example of a gain contingency. A tax loss carry forward is something that we'll talk about when we get to chapter 19. I mentioned in the last video that there are differences between accounting income and taxable income, and a tax loss carry forward is something that happens as a result of one of those differences. This is a benefit that the government allows corporations to have when they have multiple years of losses. They can carry those losses into the future and match those losses against future income so that in future years they don't have to pay taxes. So in certain situations, there were carry backs in previous years. Those have just been reinstated and carry forwards. But the point is, it represents a benefit to the company. It's a type of gain contingency. So based on something happening in the future, we may get more money in the future. These items aren't recorded. They're good to know about. We disclose them only if there's a high probability that we're going to get these things, but we need to be conservative. So for gain contingencies, they're never recorded. On the flip side of that, loss contingencies in many situations are estimated and recorded. To determine what is actually estimated and recorded, we use 3 areas of probability: probable, reasonably possible, and remote. If an event is probable, meaning we're going to lose some money in the future, and we're pretty sure that it's going to happen, then we need to estimate the amount of that loss, and we need to record an estimated liability for that. We need to go ahead and record that loss. If it's reasonably possible and it can possibly be estimated, it needs to be disclosed in the notes to the financial statements. If there's really no likelihood of it happening at all and it's remote, then we don't do anything at all in that situation. The most popular loss contingency contingency is when you go to court and you are about to lose. I use that example often with McDonald's when they had the woman who drank or ordered the hot cup of coffee, and she had really serious burns as a result of that coffee. At some point in that case, McDonald's knew that they were going to lose, and they could reasonably estimate the amount that they were going to lose, and they knew it was going to be probable. On the flip side of that, several years ago, there was a guy who wanted to sue Wendy's, a lady who wanted to sue Wendy's, who said that she found a finger in her chili. But in reality, her husband's friend got his finger cut off while he was working during the day, and she took the finger and put it in the chili and tried to say that somebody put the finger in her chili, and she did it herself. The point is, in that situation, if she tried to sue Wendy's, the probability of her winning was remote. She put the finger in the chili. But the deal is that with loss contingencies, if they're probable and we can estimate them, then we have to record an estimated liability and a loss. In some situations, it's probable that we're going to lose this money, but we may not be able to estimate it. We need to disclose that in the notes to the financial statements. If it's reasonably possible that we're going to lose, whether we can estimate it or not, it gets disclosed in the notes to the financial statements. And if it's remote, you do nothing at all. All right, there's an example here where we know we're going to lose this lawsuit. So we debit the loss. This loss shows up on the income statement with all of our other losses towards the bottom of the income statement and the other revenues and gains and other expenses and losses section of the income statement. And then the lawsuit liability is an estimated liability that will show up on our balance sheet. So even though it's estimated, it still holds as much water and value as notes payable. In the second situation, they're assuming that it's not probable, and because it's not probable, there's no journal entry that needs to be recorded. So we have several different types of loss contingencies, and listed here are the ones that we usually record. And these are the ones, these two at the bottom here, these are the ones that we're going to focus on in this chapter. But you've dealt with loss contingencies already when we dealt with bad debt. Remember our allowance for doubtful accounts, where we estimate for that and we go ahead and record bad debt expense, and we credit the allowance for a doubtful account as an adjusting entry at the end of the period. That's an example of a loss contingency that we have to deal with. Lots of companies now are offering additional warranties. And if you look at companies like Best Buy, Walmart, a lot of those tech electronic companies, that's where they make the bulk of their money, through those warranties. We're going to look at the accounting that's necessary for those warranties, because those warranties represent loss contingencies. The company is promising to pay if the equipment or if the merchandise is defective later on. They're promising to fix it. So that represents something that they're probably going to have to pay out in the future. And we also deal with premiums. Premiums are along the lines of coupons, but there's special benefits that we offer to our customers if they sort of collect box tops. I remember years ago when I was a kid, you'd buy cereal and the toy would be in the cereal. Well, now you have to send in like 6 box tops to get the toy, or they've gotten even fancier than the box tops. You take the little UPC code and you type it in to the website and you see whether or not you've won something, or you type in enough codes, and if you type in 10 codes, then you'll get, I don't know, a frozen lantern or something of that nature. We're going to look at the accounting that is necessary for when we offer those additional premiums and coupons to our customers. Now, there's some loss contingencies that we typically don't accrue for, and these are usually those that are related to risk. Risk is everywhere. Every business, as long as it's operating, it's engaging in some type of risk. If a business has a store, a production facility, there's always the risk that that store can catch on fire, or that that production facility can blow up. We don't record that risk in the financial statements. More often than not, we get insurance just in case that happens. But the insurance that we have, the risk of loss from the insurance that's supposed to cover that risk, we don't record that risk either. We don't record that potential loss either. And then there is the general or unspecified business risk. You probably saw this risk being detailed in your project from Intermediate 1 when you looked at that 10K, and they talked about the different risks that exist within a particular type of industry. The point is, we don't accrue for that. We don't do any type of journal entry, no estimated liability for general business risk. Now, the 4 items listed here, these are our loss contingencies that we may have to accrue for, we may have to do a journal entry for. So we saw the one with the litigation, the lawsuits. The same way we could expect a refund from the IRS, it may be that we're in dispute with the IRS and we may have to owe in the future. We may need to accrue for that. If we guarantee the debt of other companies or of key executives, that may be something that we have to accrue for. Or if the government comes in to take our land, there's that threat of the expropriation of assets. And also other general debt types of items where there's a standby letter of credit, or if there is a repo agreement or a repurchase agreement in terms of receivables. But our common loss contingencies, and that's really what we are going to discuss, are the litigations, claims, and assessments. We've seen what happens with litigations. That was the first example I showed you. We're going to focus on guarantee and warranty costs. We're going to look at premiums and coupons and environmental liabilities. And environmental liabilities can definitely be an issue in the future if the Green New Deal happens to get passed. We could definitely see a ton of environmental liabilities in the future. So I want you to pay close attention to that. So with litigations, claims, and assessments, I don't have to show you this anymore. This is the 3rd time that I've used this as an example. So let's move directly into the warranties. There are 2 types of warranties that companies typically offer. The first one is the assurance type warranty. This warranty is more so an implied warranty. In other words, when the customer purchases the merchandise, the corporation or the company guarantees that the product will work. That's usually an assurance type warranty. The customer doesn't pay us any extra money for this warranty. And usually it's something that may last for 30 days, 90 days. If it doesn't work, you can send it back to the manufacturer and they will fix it. The service type warranty is an extended warranty that a lot of times doesn't even start until the assurance warranty wears off. In some situations, it may start at the same time, but these are our extended 2 to 3 year warranties. You buy, I don't know, an Xbox from Best Buy, and they'll give you the option when you're trying to purchase it online. They'll give you an option to purchase a warranty, whether it's $59.99 or $79.99. That is the service type warranty. If you buy that Xbox and as soon as you get it home, you try to plug it up and it doesn't work, you can take it back to the store and they'll fix it. That is the assurance type warranty. The service type warranty, because there is an additional amount that the customer pays, there is a separate performance obligation. In other words, there's a separate revenue item that we have to deal with when we deal with the service type warranty. But let's see assurance first. So remember, assurance type warranty is that general implied warranty that when you buy the goods, they will work and perform the way that they are supposed to perform. What does the company have to do as a result of selling a product and promising that the product is going to have to pay or is going to work? Excuse me. The company has to estimate a liability, a warranty liability based on past experience for the amounts that they believe they'll have to pay just in case the item doesn't work. So let's see this example. This is a long example, tons of words, but I promise you once we sift through it, we're going to be able to pick out what we need. So we have this machinery company, and they begin producing this new machine in July, and they sell 100 of these machines for $5,000 cash by the end of the year. So we have our sales revenue. Notice that this sales price, there's no additional price for a warranty. This assurance type warranty is implied. This is just the sales price. So each machine is under warranty for 1 year. And they estimate, based on past experience with similar machines, that the warranty costs will average $200 per unit, or $20,000, because they sold 100 units. In addition, as a result of parts replacements and services performed in compliance with the warranties, they incur $4,000 in warranty costs in 2020 and $16,000 in 2021. Now, this is a perfect classroom example because we estimated that warranty costs would be $20,000, but the actual warranty costs were also $20,000. In the real world, in 2020, I have no clue how much I'm going to pay in warranty costs in 2021. In reality, I don't know what I'm going to pay in 2020, but for classroom purposes, this is enough so that I can make sure you understand this. So first, let's do the entry for the sale. I know we sold 100 of these units, and the sales price was $5,000 per unit, so we debit cash, credit sales. That's pretty straightforward. That's accounting one stuff. For number 2, let's do the entry to record the payment for the warranty costs that incurred during July 2020 and December. So from July through December 2020. We were told that we had $4,000 of warranty costs in 2020. I debit warranty expense and I credit various accounts. Now here you see a bunch of different accounts credited. There's cash, there's inventory, accrued payroll. It could be a bunch of different things. So rather than racking your brains trying to figure out which account to use, in the real world you'll know. In the classroom you won't. I like to use a term called various accounts. That's sort of my junk drawer for warranty costs. Now, those are my actual warranty costs during 2020, and notice that we made the sale in 2020. So it's okay that I record this warranty expense in 2020. I'm not violating the matching principle. But what about my 2021 costs? If I wait to record warranty expense related to this sale in 2021 when it actually happens, I end up violating the matching principle. My sale happened in 2020, the warranty cost happened in 2021. What does that mean? That means at the end of the year, I need to do an adjusting entry so that I can make sure I'm not violating that matching principle and I'm matching the sale with the actual expense. So this is where we estimate. We estimate that the warranty cost in 2021 will be an additional $16,000. So we debit warranty expense, we credit warranty liability. So we record that accrued expense. Now, when those warranty costs actually happen, doing this way ensures that I'm not violating the matching principle. I keep stressing that because that's the purpose of us doing this. When those warranty costs actually come in during 2021, I'm not going to record an additional warranty expense. In this case, I'm going to debit warranty liability, and then I'm going to credit my various accounts. I don't know if my next slide shows this. Oh, it does. So we debit warranty liability and we credit our various accounts, or cash, inventory, accrued payroll, if you want to be more specific. At the end of 2021, assuming that I don't sell any more machines in 2021, the warranty liability is totally gone. I exhausted it. Now let's deal with the service type warranty, because the service type warranty requires a separate performance obligation, which in plain English means there's an additional revenue component that I need to deal with because the customer is going to be paying me some additional money. When that customer gives me that money up front, I haven't earned it yet, especially if it's a 2-3 year warranty. I'm earning it over time. So initially, the money that the customer gives me is an unearned revenue. I haven't earned it. I earn it with the passage of time. So as time passes, we use the straight line basis to determine what portion of this unearned revenue we now record as revenue. So let's see an example. I like this example because it includes both an assurance type warranty and a service type warranty. So in this example, let's assume that we purchase an automobile from Hamlin Auto, but we are not doing the entries for ourselves. We're doing the entries for Hamlin Auto. So keep that in mind. Yes, you bought a car, but you're not doing the entries for yourself. You're doing the entries for Hamlin. We bought it for $30,000 on January 2nd. And we estimate the assurance type warranty cost on the automobile to be $700. Notice that we didn't pay anything extra for this estimate. This assurance type warranty lasts for the first 36,000 miles or for the first 3 years, whichever comes first. In addition to this implied warranty and the $30,000 that we paid for the car, we also buy an extended warranty or a service type warranty for an additional 3 years. We pay that extra $900, and that service type warranty does not start until the assurance type warranty goes away, until it expires. So for another 3 years. This is why we initially record that service type warranty as an unearned revenue. Over time, we'll earn it. All right, so Hamlet incurs warranty costs related to the assurance type warranty of $500 in 2020 and $200 in 2021, and they record the service type warranty revenue on a straight line basis. So let's look at our entries. First entry, of course, is for the sale. We know we're going to debit cash, we're going to credit sales. But it gets expanded because we also have to record that separate performance obligation. We debit cash and credit sales for $30,000, but we also need to debit cash and credit unearned warranty revenue for $900. We can do this as 2 separate entries, or you can do it as one big entry. It doesn't matter. Now, the next thing we have to deal with would be the warranty cost for 2020. But right now, the service type warranty is just sitting there. It doesn't kick into action until 3 years down the road. So it's just sitting in the unearned revenue account. But the assurance type warranty, we have some actual warranty costs. So in 2020, I'm not violating the matching principle by recording this as warranty expense. I'm matching the warranty cost with the sale in the same period. At the end of the year, I'm going to estimate for the remaining warranty liability. I want to make sure that I get my expenses matched with my revenue. So we debit warranty expense, we credit warranty liability. And then, of course, when those actual warranty costs come out, we end up debiting warranty expense and crediting our various accounts. Now, let's speed up time and let's deal with 2023. Because in 2023, my service warranty kicks into action. The assurance warranty is gone. I'm not going to have any additional costs from that assurance warranty. Any warranty costs related to this car will be for the service type warranty. Now, even if there are no warranty costs that actually happen, I still need to record my revenue because with the passage of time, I've earned 1 out of 3 of these years. We record the earning of this revenue using the straight line method, which means I take my total warranty cost and I divide it by the total number of years that this warranty will last, which is 3 years. So we're going to take that 900 and divide it by 3. We debit unearned warranty revenue and we credit warranty revenue. Notice that this is just an adjusting entry for unearned revenue. That's all this is, but it's specifically related to a warranty. We're going to do this same entry in 2024 and 2025, and that's going to take care of all 3 years. So we slowly recognize our revenue. Any warranty costs that happen as a result of this service type warranty, we just expense them. I know I'm not violating the matching principle because every year I'm recording that warranty revenue. Now, the discussion of loss contingencies in terms of our premiums is a bit of a longer discussion. So I'm going to end the video right here only because I want you to take a look at the walkthrough video for warranty so you can get that in your heads. And then in the next video, I will discuss the premium liabilities as well as how we deal with coupons in more detail. So I appreciate your time and attention on this short video, and I hope you have a great